All right, let's dive straight into one of the most critical accounting standards for your exams, AS-10, Property, Plant, and Equipment. We're going to break down everything you need to know about getting an asset on your books for the first time, the right way. Let's get this mastered.
So, let's kick things off with a classic ICAI trap. Picture this, you've just built a fantastic new factory and you throw a huge inauguration party. It costs you a cool 5 lakh rupees. Now, the big question is, can you capitalize that? Can you add it to the cost of the factory? This is exactly where easy marks are lost. But by the end of our session today, you'll know precisely how to deal with this.
Think about the typical exam question. The examiner just hands you this long, intimidating list of 20 different costs for a new plant. You've got site prep, architect fees, staff training, advertising, maybe even some early operating losses. Your job is to sift through all of that and calculate the final correct cost of the asset. Well, AS-10 is basically your rulebook for solving this exact puzzle, and today we're going to master it.
Okay, first things first. We have to lay a solid foundation. Before we can even think about capitalizing costs, we need to be absolutely crystal clear on what AS-10 is talking about. What is property, plant, and equipment? Getting these basics right is non-negotiable.
So the whole point of AS-10 is to give us the official rules for dealing with PPE, when to record it, how to value it, how to depreciate it, and so on. It covers pretty much all PPE unless another standard, like AS-19 for leases, has its own specific rules. And here's a super important note for exams. AS-10 applies to bare plants, but not to the fruit or produce actually growing on them. That's a key distinction.
So what exactly is PPE? It's actually pretty simple. It has to be a tangible item, something you can touch, and it has to meet 2 simple checkpoints. First, you're holding it to use in your business, not to sell. And second, you expect to use it for more than 1 year. You have to tick both boxes. That's it.
Now for a topic ICI absolutely loves to ask about, bearer plants. For a plant to be a bearer plant, it has to meet 3 conditions. 1, it's used to grow stuff. 2, it does this for more than a year. And 3, you have no real intention of selling the plant itself, only its produce. You know, think of an apple tree in an orchard. Its job is to make apples year after year. You're not planning to chop it down and sell it for wood. That's a bearer plant.
This slide just makes that difference super clear. Tea bushes, bearer plants. Rubber trees, bearer plants. But trees you're growing specifically to cut down for lumber, that's not PPE. That's your inventory. Same with annual crops like wheat. This is a high-frequency exam area because the distinction is subtle, so getting this clear in your head is a must.
Okay, so we know what counts as PPE. The next huge question is, when do we actually get to put it on our balance sheet? This brings us to what I call the 2 golden rules of capitalization under AS-10. These are the gatekeepers, and here they are. You can only, and I mean only, recognize an item as PPE if both of these rules are met. First, it has to be probable, not just a vague possibility, but likely that you're going to get some future economic benefit from it. And second, you have to be able to measure its cost reliably. You need a solid number. In your exam, any decision to capitalize has to be backed up by these 2 rules.
Let's put this to the test right now. A supermarket remodels one of its stores. They've done their research and are expecting a 15% jump in sales because of it. Should they capitalize that remodeling cost? Just think about those 2 golden rules we just talked about. And the answer is a big yes. But why? Well, it ticks both boxes perfectly. That expected 15% sales increase, that's your probable future economic benefit right there. And can they measure the cost of the renovation reliably? Of course, they have invoices. See how we link the decision directly back to the 2 rules? That's how you score the marks.
So, we've decided to recognize the asset. Fantastic. Now for the fun part, the math. What exact amount do we record in our books? This next step is all about the practical calculation of what actually gets included in that initial price tag.
Okay, the cost of PPE has 3 main building blocks. First, you've got the purchase price, plus any non-refundable taxes. But, and listen up, because this is where people lose easy marks, you must subtract any trade discounts or rebates. Second, you add all the directly attributable costs, basically any cost needed to get the asset to where it needs to be and ready to work. And third, you include an estimate for any future costs to dismantle it.
Let's look at a problem that feels like it's straight out of an ICAI paper. A company buys new machinery, and then they get a whole list of other bills: site preparation, salary for the technician who set it all up, delivery charges, architect's fees.
Your job is to figure out the final number that goes on the balance sheet.
So here's how we tackle it. We start with the purchase price, obviously. Then we go down the list one by one. Was the site preparation necessary to get the machine working? Yes. What about the technician's salary during setup? Absolutely. Delivery cost? Yes. Architect's fees? Yep. All of these are directly attributable costs. So we just add them all up, and we get our final capitalized cost of 1,61,55,000.
Now this next section is absolutely critical. Knowing what to include is one thing, but to avoid negative marks, you have to be an expert on what not to capitalize. This is where ICA really tests if you understand the standard or if you've just memorized the list.
You need to burn this list into your memory. These are the classic ICI traps. Remember that 5 lakh inauguration party we talked about at the start? Well, here's your official answer. It's a cost of opening a new facility, so it gets expensed, not capitalized. Same goes for advertising a new product, staff training, general overheads, and those initial operating losses. These are all costs of running the business, not costs of getting the asset ready.
Here's a really sneaky one. An amusement park has its soft opening, running at 80% capacity before its grand opening. They lose some money during this period. They argue that this was a test phase, so the losses should be capitalized. What do you think? Is this cost necessary to make the park ready for use?
And the answer is a firm no. And here's the subtle trick ICI is playing. The key phrase in the standard is whether the asset is capable of operating as intended, not whether it's operating at full capacity. Since the park was open and had customers, it was clearly capable of operating, so those costs are just regular operating costs, and they have to be expensed in the P&L. It's a small difference in wording, but a huge difference in marks.
And this is it. This is the most important rule for asset exchanges. It all comes down to this one question. Does the transaction have commercial substance? In simple terms, that just means, is my company's future cash flow position going to change significantly because of this trade? If the answer is yes, you record the new asset at its fair value. If the answer is no, you record the new asset at the carrying amount, the book value, of the old asset you gave up.
Let's apply that right now. We trade car X for a bit of cash and a new car Y. Now, look closely at the question. It gives you all these numbers, book value, fair value, but then it gives you the most important clue. It says the transaction lacks commercial substance. That is your signal. That phrase tells you exactly which rule to use.
Since it lacks commercial substance, we completely ignore all the fair values. They are just there to distract you. We follow the rule. We start with the carrying amount of the asset we gave up, the book value of car X, which is 13 lakhs. Then we subtract any cash we received, which was 15,000. And there's our answer. The new car, car Y, is recorded at 12,85,000 rupees. Simple as that.
Okay, to wrap things up, let's just quickly cover one last special scenario, so you're prepared for absolutely anything they might throw at you. And that is, what if you build an asset yourself?
When you build your own asset, the rules are mostly the same. But there are a few extra things to watch out for. First, you can't include any internal profit you might have booked on the construction. Second, and this is important, you have to exclude any abnormal waste. If you mess up and waste a bunch of material, you can't capitalize that cost. Normal waste is okay. Abnormal is not. And of course, you'd include borrowing costs if AS-10 allows it. Same rules apply to bearer plants, by the way.
You know that 10,000 rupee repair cost you see in an exam question? What if I told you that one small decision could literally cost you 5 marks? It seems simple, right? Repair, expense it. But is it always that straightforward? Well, that's a classic ICAI trap. Getting this wrong could be the difference between passing and failing that question. So let's make sure that never happens to you. We're going to break down the rules step by step so you know exactly when to capitalize and when to expense.
All right, let's look at a typical exam problem. You've got ABC Limited. They own a machine. Now, in one single year, they've done 3 things. Some routine servicing, they've replaced a major part, and now they're thinking about revaluing their entire factory. Now, each one of these things needs a different accounting treatment, right? And this is what ICAI loves to do. They'll throw all of this into one big question to really test if you understand AS-10. So the question is, how do we untangle this mess? Well, let's go through the rules one by one. All right, Section 1, Subsequent Costs. Capitalize or expense? Seriously, this decision can be the difference between a pass and a fail. This is probably one of the most frequently tested areas from this part of AS-10, so getting this right is, well, it's absolutely fundamental. Okay, let's get one thing straight right off the bat. Day-to-day servicing. What are we talking about here? Things like labor costs, consumables, small parts, basically your everyday repairs and maintenance. The treatment for this is simple. It is always an expense. It goes straight to the statement of profit and loss. You never, ever capitalize it. The whole point of these costs is just to keep the asset running, not to make it better. So the second you see day-to-day servicing in an exam question, your brain should scream P&L. Don't even hesitate. Capitalizing this is a classic mistake, and it's a guaranteed way to lose marks. So if we expense day-to-day stuff, what do we capitalize? Well, this table breaks it down nicely. Look, on one hand, you have your regular repairs and maintenance. That's an expense to the P&L. But on the other hand, what about replacing a significant part? Let's say relining a furnace or putting new seats in an aircraft. If it meets the recognition criteria, you capitalize that. Same goes for major inspections. Think about an aircraft again. It needs regular, major inspections just to be allowed to fly. The cost of that inspection is capitalized as if it were a replacement. So the question you need to ask yourself is this. Is this just routine upkeep, or are we replacing a major component or doing something essential to keep it operating? That's the real difference. Now, when you do capitalize a new part, this formula is absolutely critical. And I need you to listen very carefully because this is where so many students go wrong. The new written down value isn't just the old WDV plus the cost of the new part. You also have to subtract the WDV of the old part that you're replacing. People always remember to add the new part, but they forget to take the old one out of the books. You have to derecognize it. It's not optional. It's a non-negotiable step. Okay, so the obvious question is, how in the world do I find the WDV of the old part? Good question. AS-10 gives us a clear pecking order. Step 1, and the best option, is to check the original supplier's invoice. Maybe they listed the part separately. If that's a no-go, then step 2 is to use the fair value of that part at the time you bought the whole asset. And if even that is not practical, step 3 is your last resort. You can use the cost of the new replacement part as an estimate for what the original old part cost. It's a pretty logical progression, right? All right, we've nailed subsequent costs. Let's move on to the next big topic. After you've first recognized an asset, you have a choice to make about how you account for it going forward. This is the big policy decision, the cost model versus the revaluation model. So what's the difference? It's pretty straightforward. On the left, you have the cost model. This is simple. The asset is carried at its cost minus accumulated depreciation and any impairment. It's all based on the historical price you paid. On the right, we have the revaluation model. This is totally different. Here, the asset is carried at its fair value, its market value, on the date you revalue it, minus any depreciation you calculate after that date. So you can think of it this way. The cost model looks backwards, to the past. The revaluation model looks at the present. What is this asset worth today? Now, here's a really important rule you need to know. You can't just pick and choose which assets to revalue. The standard is very clear. You have to apply the same model, either cost or revaluation, to an entire class of PPE. What's a class? Well, it's a group of similar assets, like all your land, or all your machinery, or all your aircraft. So if you decide to revalue one of your buildings, you have to revalue all your buildings in that class. No cherry picking. This is a major point, and ICAI loves to test this concept. So why does this entire class rule even exist? Well, it's to stop companies from playing games with their balance sheet. The standard wants to avoid selective revaluation, where a company might revalue the assets that have gone up in value, but conveniently leave the ones that have gone down at their original cost. For example, let's say a company owns both office buildings in a prime city location and industrial buildings in a factory area. These are two different classes of assets. So the company could choose to revalue the office buildings, which have probably increased in value, but keep the industrial buildings on the cost model. That's allowed because they are different classes, but they couldn't revalue just one of their office buildings. Okay, so you've pulled the trigger. You're going to revalue a whole class of assets. Now what? Well, welcome to what I call the revaluation maze. This is all about navigating the accounting entries, which can get a little tricky depending on whether the asset's value has gone up or down. So how often do you have to do this? The standard is a bit vague. It just says, with sufficient regularity. But what does that actually mean? Well, it depends. If the fair value of your assets is changing a lot and is very volatile, think about property in a hot real estate market, you might need to revalue them every single year. But if the changes in fair value are pretty small and insignificant, then revaluing them every 3 to 5 years is probably okay. The main goal here is simple. You just need to make sure that the carrying amount in your books isn't wildly different from the actual fair value at the balance sheet date.
When it's time to actually record the revaluation, you've got two techniques to choose from. The first is called proportional restatement. Here, you basically scale up both the gross carrying amount and the accumulated depreciation by the same percentage. The second technique is the elimination method. This one is often easier. You just eliminate, or wipe out, the accumulated depreciation against the gross cost of the asset. Then you take that net amount and restate it to the new revalued amount. Both methods get you to the same place, but honestly, the elimination method is often faster in an exam, so it's a really good one to get comfortable with.
Okay, I need you to focus very carefully on this next part because this is a huge area where marks are won and lost. Let's talk about where the gain or loss goes. If the value of an asset increases, the gain goes to something called revaluation surplus, which sits in your equity. Simple enough, but there's a catch. If that increase is just reversing a loss that you previously charged to the P&L for that same asset, you have to credit the P&L first up to the amount of that old loss. Now, what if the value decreases? The logic just flips. Normally, a loss would go straight to the P&L. But if you already have a revaluation surplus for that specific asset from a prior revaluation, you have to use up that surplus first. You debit the surplus until it's gone, and only then does any remaining loss hit the P&L. The golden rule is you always reverse the previous entry for the same asset first.
All right, let's switch gears and talk about depreciation. Now, I know what you're thinking, depreciation, I know this, but trust me, AS-10 has some specific nuances and rules that are designed to catch you out in an exam if you're not paying attention. And here's a really big one, the component method of depreciation. The rule is this: if an item of PPE is made up of different parts, and the cost of those parts is significant compared to the total cost, you have to depreciate each of those parts separately. The go-to example is always an aircraft. Think about it. The main body, the airframe, might last for, say, 20 years. But the engines, they have a much shorter life and need to be replaced more often. It would be totally wrong to depreciate the entire plane over 20 years. Instead, you treat the airframe and the engines as separate components and depreciate them over their own individual useful lives.
Here's something important. Your initial estimates for useful life and residual value are not permanent. The standard says you must review them at least once every financial year end. And if you find that your expectations have changed, maybe a machine is going to last longer than you originally thought, that's called a change in accounting estimate. Now, how do you account for it? According to AS-5, you do it prospectively. What does that mean? It means you don't go back and change the past. You just adjust your calculations for the current year and all future years. It's like recalculating your GPS route halfway through a trip. You don't go back to the starting point. You just find the new best path from where you are right now.
Let's make this real with a quick example. Say you bought an asset on January 1st, 20x1 for a lakh. You figured it would last 10 years, so you've been depreciating it by 10,000 rupees a year. 4 years later, it's January 20x5. You've charged 40,000 in depreciation, so the written down value is now 60,000. But now, management reviews the asset and says, you know what? This thing is only going to last for another 4 years, not 6. So what do? You take the current WDV, that's 60,000, and you divide it by the new remaining life, which is 4 years. So your new depreciation going forward is 15,000 per year. See? We didn't touch the past, we just adjusted the future. Okay, let's talk about the start and stop dates for depreciation, because this is a favorite for MCQs. You start depreciating an asset when it is available for use. This is a crucial phrase. It doesn't mean when you start using it. It means when it's in the location and condition necessary for it to be capable of operating in the way management intended. So if a machine is delivered and installed on June 1st, but you don't turn it on until July 1st, depreciation starts in June. And when does it stop? It stops at the earlier of two dates, the date the asset is classified as held for disposal or the date it's derecognized. And one more thing, depreciation does not stop just because an asset is idle for a while. That machine is still getting older and losing value, even if it's not currently running. All right, next up, let's talk about land and buildings. These are obviously very common assets, and the standard has some specific rules for how to handle them. Okay, rule number 1, land and buildings are treated as two separate assets. Even if you buy them together as one package deal, for accounting purposes, you have to split them. Why? Because land, for the most part, is considered to have an unlimited useful life, so you do not depreciate land. There are some rare exceptions like quarries, but generally, no depreciation on land.
Buildings, however, have a limited useful life, so you absolutely do depreciate them. And here's the trap. The value of the land has zero impact on the depreciation of the building on it. So if the land value goes up, don't let that fool you into thinking you should stop depreciating the building. They are two separate things. So how do you choose a depreciation method? You've got options: straight line, diminishing balance, units of production. The key principle is that the method you choose should reflect the pattern of how you expect to use up the asset's economic benefits. But, and this is a huge warning, you can never use a depreciation method that is based on the revenue an asset generates. The standard explicitly forbids this, which makes it a perfect exam question. Why is it forbidden? Because revenue is influenced by all sorts of things: inflation, your sales prices, marketing, that have nothing to do with the physical wear and tear or obsolescence of the asset itself. So if you see an option to depreciate based on revenue, it's a trap. Avoid it. All right, we're on to our last section now, and this one is a bit more advanced. This is the kind of topic that IKI can use to really separate the good students from the great ones. We're talking about what happens when you have a change in a decommissioning or restoration liability. Think about the future cost of dismantling a factory you've built. What happens when your estimate of that cost changes? Okay, let's look at the two scenarios. If your asset is measured using the cost model, it's pretty straightforward. Any change in that liability, up or down, is just added to or deducted from the cost of the asset. Easy. But if your asset is under the revaluation model, it gets a bit more complex. If the liability decreases, meaning your future cleanup cost is less than you thought, that's good news, right? So you treat it like a gain and credit it to the revaluation surplus. But if the liability increases, meaning the cleanup is going to cost more, that's bad news. You treat it like a loss and it gets debited to the P&L. Unless, of course, you have a revaluation surplus for that asset that you can use up first. It follows the exact same logic as regular revaluation. It's a tricky point, but getting it right really shows you know your stuff. Okay, let's just dive right in with a question that trips up so many students. Take a look at this. It is a classic ICAI MCQ trap. So, do you credit it to the P&L or maybe transfer it somewhere else? This is exactly the kind of question where crucial marks are won or lost. And today, we're going to make sure you're on the winning side. All right, let's get into our first section. Now, you might be thinking, wait, why are we starting at the end of an asset's life? Well, it's because this is where that tricky revaluation puzzle from our first slide comes into play. What exactly happens when an asset gets sold or scrapped? And here it is, the direct answer to our opening question. The common mistake, the trap that ICAI loves to set, is thinking that since the asset is sold, the profit is realized, and the reserve should just go to the P&L. That is wrong. The correct treatment under AS-10 is to transfer the balance in the revaluation surplus directly to general reserves, or retained earnings. You see, this is a capital profit realization, not an operating one, so it completely bypasses the P&L account. That last point is absolutely key, so make sure you've got it locked in. So what exactly is derecognition? It sounds a bit technical, but it's really just the official term for removing an asset from your books. This could be because you've sold it, leased it out, maybe donated it, or simply because it's old and isn't going to generate any more money for the business. This slide here lays out the exact four-step process you need to follow. Let's break it down. First, you figure out the book value, the carrying amount, on the day you sell the asset. Second, you compare that with what you actually got for it, the net proceeds, to calculate a gain or a loss. Now, this gain or loss, that goes to the P&L. But, and this is the key, the P&L impact in Step 2 and the reserve transfer in Step 3 are two totally separate journal entries. You have to show them both. And one final important note. Any gain on the sale is not revenue under AS-9. It's a gain on disposal, a completely separate line item. So, picture this. Your machine, worth 2 lakhs in the books, is totally gone, but the insurance company gives you a brand new one worth 20 lakhs. So you just net it off and book an 18 lakh gain, right? The answer is a definite no, and this is another classic ICAI twist. The one thing you have to remember here is that these are two distinct economic events, and you have to account for them separately. First, you must derecognize the old asset. That means you take its carrying value of 2 lakhs and book it as a loss in your P&L account, as per AS-10. Separately, when it's virtually certain you're getting the insurance money, you recognize a receivable and a gain in the P&L under AS-29. You never, ever net them off. ICAI loves asking for a single net entry, but that is flat out incorrect. 2 events, 2 separate accounting treatments.
And just a quick related point before we move on, if you retire an asset from active use and you're just holding on to it to sell it, You need to value it at the lower of its current book value and whatever you think you'll get for it. If you have to write it down, that loss hits the P&L straight away. This slide is basically your cheat sheet for capitalization. The rule is simple. You capitalize the purchase price and any cost that is directly attributable to getting that asset to the right location and in the right condition to operate. So things like non-refundable import duties, delivery, and installation costs are in, but the real exam trap is knowing what's out. Notice that initial operating losses, admin overheads, and relocation costs are all expensed to the P&L. Why? Because they're costs of running the business, not costs of getting the asset ready. Let's actually build up the cost of an asset step by step. You start with the purchase price. But here's a key point. You have to deduct any refundable taxes like GST where you can get input tax credit. Then, you just systematically add all the direct costs. Site prep, any labor and supervisor salaries you can directly attribute, test run expenses, and here's one people often forget. Even the depreciation of other assets that you used just for the installation. It's a systematic buildup of every direct cost. Okay, and here is a massive exam tip where marks are lost all the time. 2 items you should always expense to the P&L and never ever capitalize for a non-qualifying asset. Interest paid to a supplier for buying on credit, and any operating losses you make before the asset hits commercial production. These are financing costs and operating expenses, not asset costs. Please burn this into your memory. Take a look at this argument. A company claims that since they have a maintenance contract, they don't need to depreciate the asset. It sounds kind of logical, right? But it's totally wrong. Let's just bust this myth right now. An annual maintenance contract is a running cost you pay to fix the wear and tear. Depreciation is the systematic allocation of the asset's original cost to account for that very same wear and tear over its life. They're 2 sides of the same coin. One does not replace the other. Depreciation is mandatory, full stop. The other arguments, like property values going up or it being a non-cash expense, are also completely invalid. We're in the home stretch now. Let's talk about disclosures. I know, it might seem like the most boring part, just a list of things to write down. But in the exam, getting the disclosures right is the key to getting those full marks and showing the examiner that you have a complete grasp of the standard. First up are the general disclosures. These are the fundamentals. You have to tell the reader your policy. Are you using the cost model or the revaluation model? What depreciation methods and useful lives are you using? But the absolute crucial disclosure, the one that ties everything together, is the PPE reconciliation or schedule. This is the table that shows the entire movement for the year: opening balance, additions, disposals, depreciation, and closing balance. Examiners love to see this laid out nice and clear. Next, we've got some additional disclosures that give a bit more insight. If you've pledged any assets as security for a loan, you have to disclose that. You also need to show how much you're investing in the future by disclosing capital work in progress and any firm contracts to buy assets. And remember our impairment section? That compensation you got from the insurance company? That gain needs to be specifically disclosed in the P&L notes. And finally, if you use the revaluation model, you've got to be super transparent. So there's an extra set of disclosures. You have to state that the effective date of the valuation and, importantly, whether an independent valuer was involved. That adds a lot of credibility. You also have to explain the methods and key assumptions you use to get to the fair value. And just like the main PPE schedule, you need to show a full reconciliation of the movement in the revaluation surplus account for the period. Just remember, disclosures are not just a box-ticking exercise. They provide transparency, and they tell the reader of the financial statements the complete story of how a company is investing in its assets, managing them, and planning for the future. They really are the narrative behind the numbers. So let's just end with this thought. After breaking down all these ICI traps, I really hope you say AS-10 differently. It's not just a collection of rules you have to memorize. It's a logical framework that's designed to make sure that the value of an asset on the balance sheet actually reflects its economic story, from the day it was bought, all through its useful life, to the day it was sold. Keep that core principle in mind, and you'll be able to tackle any question that comes your way. All the very best for your exams. You've got this.